Before we begin, please note that I am not a licensed financial advisor, attorney, or real estate professional. The information provided in this video is for educational and informational purposes only and should not be considered financial, legal, or investment advice. Investing involves risk, including the potential loss of principal. Always conduct your own due diligence and consult with qualified professionals before making any investment decisions. You've done everything right. You've saved up a down payment, your credit score is solid, and you've spent months, maybe even years scrolling through Zillow, Redfin, and Realtor.com. You finally find it, the one. Not a dream home to live in, but something even better. Your first investment property. A duplex that could pay for its own mortgage and then some. A single-family house in a great rental neighborhood that could be the first step toward building real wealth. You run the numbers, you get excited, you call your bank, the same bank that approved you for your car loan, the one where you have your checking account, and you tell them you're ready. And then you hear the words that stop so many aspiring investors dead in their tracks. I'm sorry, but based on your debt-to-income ratio, we can't approve you for another loan right now. Feels like a punch to the gut. It's a wall. A giant brick wall that separates you from your financial goals. Your income is good, but you already have a mortgage on your own home. You have a car payment, maybe some student loans. And according to the bank's rigid one-size-fits-all checklist, you're too much of a risk. The dream of passive income, of building a portfolio, of achieving financial freedom, it just evaporates. What if I told you that wall is an illusion? What if I told you that the most successful real estate investors in the country almost never use the type of loan you just got rejected for? They use a completely different tool. A financial key that unlocks door after door, property after property, without ever caring about your 9-to-5 salary or your personal debt. This is not some get-rich-quick fantasy. This is a fundamental structural difference in how real estate is financed in the United States, and today, you are going to learn exactly how it works. We are talking about investment loans, and by the end of this presentation you will not only understand what they are, but you will understand the mindset shift that allows lenders to give these loans to investors who buy 2, 10, even 50 properties. You'll understand the single most important number they look at, and I guarantee your local bank teller has never mentioned it to you. This knowledge is the dividing line between amateur landlords and professional real estate investors, and you are about to cross it. So, what is an investment loan, and why is it the secret weapon for building a real estate empire? At its core, an investment loan is a mortgage where the lending decision is based primarily on the investment property's ability to generate income, not on your personal salary. Let that sink in for a second. It's a complete 180-degree flip from how you think about getting a loan. When you applied for the mortgage on your primary home, what did the bank obsess over? They wanted your W-2s for the last 2 years. They wanted your tax returns. They scrutinized your pay stubs. They calculated your debt-to-income ratio down to the decimal point. They were underwriting you. They were betting on your ability as a person with a job to pay back the loan every single month for 30 years. Your house was just the collateral. An investment loan flips the script. With this type of loan, the property isn't just the collateral. The property is the applicant. The lender's first and most important question is not, how much money do you make at your job? It's how much money does this property make? This is the fundamental mindset shift. You are no longer just a borrower. You are the manager of a small business. And the property is that business. The rent it collects is its revenue. Its expenses, things like taxes, insurance, and maintenance, are its operating costs. The money left over is its profit. The investment loan lender is essentially acting like a business partner, and they want to know if the business they're about to invest in is profitable. This brings us to the single most important metric in the world of investment property lending. It's a term you need to burn into your brain: DSCR. DSCR stands for debt service coverage ratio. It sounds complicated and intimidating, but the concept is incredibly simple. It's a simple division problem that answers one question. Does the property's income cover its mortgage payment? And by how much? The formula is net operating income divided by total debt service. Let's break that down into plain English. First, net operating income, or NOI. This is all the income the property generates, primarily rent, minus all the expenses required to keep it running. And I mean all of them. This includes property taxes, homeowners insurance, any HOA fees, and estimates for vacancies and maintenance. It does not include the mortgage payment itself. Think of it as the property's profit before you pay the bank. Second, total debt service. This is just a fancy term for the total mortgage payment. It's your principal, interest, taxes, and insurance, all bundled together. The full pity payment. So the DSCR is simply the property's monthly profit, before the loan, divided by the property's total monthly loan payment. Let's use a real-world example. Imagine you're looking at that duplex that your bank rejected you for. Let's say each side rents for $1,500 a month, for a total gross rental income of $3,000. Now let's subtract the expenses. Property taxes are $300 a month. Insurance is $150 a month. And the lender will usually factor in a vacancy and maintenance estimate, let's say 10% of the rent, which is another $300. So your total monthly operating expenses are $300 plus $150 plus $300, which equals $750. Your net operating income is your gross rent of $3,000 minus your expenses of $750. That gives you an NOI of $2,250 per month. This is the number the lender cares about most. This is the cash the property generates to pay its own bills. Now let's look at the loan. Suppose the new mortgage payment, the total debt service, for this duplex would be $1,800 per month. To find the DSCR, you just divide the NOI by the debt service. So $2,250 divided by $1,800. The answer is 1.25. Your DSCR is 1.25. What does that number mean? It means that for every $1 you owe the bank each month, the property is generating $1.25. It means the property's income covers its own mortgage payment with a 25% buffer left over. To a lender, that 1.25 is beautiful. It's a healthy, cash-flowing property. It's a good business to invest in. Most DSCR lenders are looking for a ratio of 1.2 or higher. Some are okay with 1.15 and some even go down to 1.0, meaning the property just breaks even. But that 1.25 in our example? That's a green light. That's an approval. And did you notice what we didn't talk about? We didn't talk about your salary. We didn't talk about your car payment. We didn't talk about the mortgage on your primary residence. While the lender will still check your credit score and want to see that you have some cash reserves, those factors are secondary. The star of the show, the hero of the story, is the property's DSCR. This is why the wall your bank put in front of you is an illusion. You were playing the wrong game. You were trying to use the rules of personal finance to play the game of business finance. With a DSCR loan, your ability to get financing is no longer limited by your personal income. It is limited only by your ability to find properties that cash flow. This is how investors scale. This is how they buy a second, a third, a 10th property. Each new property qualifies on its own merits. As long as they can find deals where the rent covers the expenses and the mortgage with a healthy buffer, they can continue to get funding. It's a system built for growth. It's a system designed to create wealth, not just provide shelter. And it's a system that is now accessible to you. But how exactly? How do you step onto this escalator of wealth creation? It feels like a club with a secret handshake, doesn't it? You see people buying their second, third, 10th property and you wonder, what do they know that I don't? The answer is simpler and more accessible than you've been led to believe. They don't have a magic money tree. They just understand the rules of the game. And today I'm handing you the rulebook. Let's pull back the curtain on what it actually takes to get approved for a U.S. investment loan. Forget the intimidating jargon and the gatekeeping you see online. We're going to break this down into 3 core pillars. 3 fundamental metrics that every lender, from the biggest bank on Wall Street to your local credit union, will look at. They are your credit score, your debt-to-income ratio, and your down payment and reserves. Think of them as the 3 legs of a stool. If one is weak, the whole thing gets wobbly. But if all 3 are solid, you've built a foundation for a financial empire. Let's start with the first pillar, your credit score. This is probably the one you're most familiar with, but for investment properties, it takes on a whole new level of importance. Your credit score isn't just a number. It's your financial reputation. It's a single data point that tells a lender how trustworthy you are with other people's money. Have you paid your bills on time? Have you been responsible with the credit you've been given? A high score screams reliable. A low score whispers risk. For a primary residence, you can sometimes get a loan with a score in the low 600s. For an investment property, the bar is higher. Lenders see it as a business transaction, not a quest for shelter, so they are far less forgiving. Generally, you'll want to have a credit score of at least 680 to even be in the conversation. But the real sweet spot, where you start getting access to the best interest rates and most favorable terms, begins around 720, and ideally 740 or higher. Think of it like this: a higher credit score is your VIP pass. It gets you past the velvet rope, gets you the better table, and comes with a lower bill at the end of the night. A few points on your credit score can translate into tens of thousands of dollars saved over the life of a 30-year loan. So how do you polish this score? It's not black magic. It's simple discipline. Pay every single bill on time every time. That is non-negotiable. Keep your credit card balances low, ideally below 30% of your available limit. Don't go opening a bunch of new accounts right before you apply for a loan. And don't close your oldest credit accounts, as they are the bedrock of your credit history length. It's about demonstrating long-term, consistent, boring reliability. In the world of lending, boring is beautiful. Now for the second pillar, and this is where a lot of people get tripped up: your debt-to-income ratio, or DTI. If credit score is your reputation, DTI is your capacity. It answers the lender's most pressing question: can you actually afford to take on this new debt? It's a simple, brutal calculation. They take all of your monthly debt payments, your current mortgage or rent, your car payment, student loans, minimum credit card payments, and they add them up. Then they divide that number by your gross monthly income, the money you make before taxes. Let's make it real. Say you earn $8,000 a month. And let's say your current mortgage is $2,000, your car payment is $500, and your student loan and credit card minimums total another $500. Your total monthly debt is $3,000. So you take $3,000, divide it by your $8,000 income, and you get 0.375. Your DTI is 37.5%. For an investment property loan, most lenders want to see that number stay below 43%, and some are even stricter, capping it at 40%. Why? Because they know you still have to pay for groceries, gas, utilities, and life. They need to be absolutely certain that adding another mortgage payment won't push you over the financial edge. The DTI calculation is the lender's stress test on your personal finances. It's their way of ensuring you're not biting off more than you can chew. To improve your DTI, the formula is simple. Either decrease your debt or increase your income. Paying off a small loan or a credit card before you apply can have a massive impact on your qualifying power. And that brings us to the third, and arguably most critical, pillar for an investment loan: down payment and reserves. This is what separates the casual homebuyer from the serious investor. This is where you prove you have skin in the game. When you buy a house to live in, you can often get away with a down payment as low as 3% or 5%. For an investment property, forget it. Lenders see this as a higher risk venture. If you hit hard times, which mortgage are you more likely to stop paying first? The roof over your own head, or the one over your tenant's head? They know the answer. To offset that risk, they require you to put more of your own money on the line. The industry standard for an investment property down payment is typically 20% to 25%. On a $300,000 property, that's a down payment of $60,000 to $75,000. This large chunk of equity makes you a much safer bet. You're far less likely to walk away from a property when you have that much of your own capital tied up in it. But it doesn't stop with the down payment. Lenders also want to see that you have reserves. Cash reserves. This is your emergency fund, your safety net. After you've paid your down payment and all your closing costs, the lender wants to see that you still have enough liquid cash in the bank to cover several months of the total mortgage payment. That's principal, interest, taxes, and insurance on the new investment property. How many months? It varies, but a common requirement is 6 months in reserves. So if the total mortgage payment on your new rental is going to be $2,000 a month, the lender will want to verify that you have an extra $12,000 sitting in a checking or savings account. This proves to them that if your tenant suddenly moves out and the property sits vacant for a few months, you won't immediately default on the loan. It's a buffer. It's a sign of a prudent, prepared investor. And it's a non-negotiable for most lenders. So you need a strong credit score, a low DTI, and a hefty pile of cash for the down payment and reserves. At this point, you might be thinking, this sounds impossible. This is a club for the rich. And if that were the whole story, you might be right. But we've only talked about the 3 pillars that relate to you, the borrower. We haven't talked about the secret weapon, the one factor that completely changes the equation and makes this whole system work. That secret weapon is the property itself. When you apply for a loan on a primary home, the qualification is all about you. Your income, your debts. But with an investment loan, the property gets to help you qualify. Lenders will take the projected rental income from the property and use it to offset the new mortgage payment. Let's go back to our DTI example. Your new investment property has a mortgage of $2,000. Adding that to your existing $3,000 in debt would bring your total to $5,000. On an $8,000 income, your DTI would shoot up to 62.5% and instant denial. But here's the magic. The lender gets an appraisal, which includes an estimate of what the property will rent for. Let's say it's projected to rent for $2,500 a month. The lender won't use the full amount. They'll typically use 75% of it to account for potential vacancies and expenses. So, they'll credit you with $1,875 in income. They add this to your existing income, or more commonly, they use it to directly reduce the proposed housing payment. That $2,000 mortgage payment is now effectively just $125 in the DTI calculation. $2,000 minus $1,875. Your new total debt for qualification purposes is now just $3,125. Your DTI is a comfortable 39%. You just went from an automatic no to a very likely yes. This is the key. This is the engine of real estate scaling. The property's own potential income helps you qualify to buy it. It's a virtuous cycle. As long as you buy properties that cash flow, where the rent covers the expenses and the mortgage with a healthy buffer, you can keep qualifying for more. So now you know the core components. You understand the metrics that matter: your reputation, your capacity, and your skin in the game. And you understand the incredible leverage that the property's own income provides. You have the foundational knowledge. But this is just one type of loan, the conventional, traditional path. What if your credit isn't perfect? What if you're self-employed with a complex income history that's hard to prove on paper? What if you don't have 25% to put down? You might think you're locked out of the game. But you're not, because there are different keys for different doors. There are other types of investment loans, each with its own set of rules, its own loopholes, and its own secret advantages. And one of them, a loan that focuses almost entirely on the property and not on you, is called the DSCR loan. And for many investors, it changes everything. So what exactly is a DSCR loan? The name itself sounds like something cooked up in a corporate boardroom, designed to be intimidating. DSCR stands for debt service coverage ratio. And I know your eyes probably just glazed over. It sounds complicated, but I promise you, the idea behind it is so devastatingly simple and so powerful that it's the secret key that has unlocked the real estate empires of thousands of investors who were previously told no. Imagine a first-time investor. Let's call her Jessica. Jessica has a great job as a graphic designer. She makes a solid salary, has good credit, and has diligently saved up a 20% down payment for an investment property. She's done everything right. She finds a perfect little duplex in a growing neighborhood. The numbers work. It's a great deal. She goes to her local bank, the same one she's used since she was a kid, and applies for a conventional investment loan. And she gets rejected. Why? Because of her debt-to-income ratio. Between her own mortgage, her car payment, and the last of her student loans, the bank's algorithm looks at her file and says, adding another mortgage on top of all this is too risky. The underwriter doesn't see Jessica, the responsible saver. He doesn't see the fantastic cash-flowing duplex. He only sees a number on a spreadsheet that's a little too high. The computer says no. The dream is dead. This is where millions of potential investors get stuck. They hit this wall. They have the capital, they have the ambition, they found the deal. But their personal financial snapshot, their W-2 job, their existing debts becomes an anchor weighing them down. The DSCR loan walks into this situation and flips the entire table over. It looks at the banker's rulebook, lights it on fire, and asks one single question, a question so logical it's almost revolutionary. Does the property make enough money to pay for itself? That's it. That's the entire philosophy. The lender, in this case, isn't primarily concerned with Jessica's job as a graphic designer. They don't really care about her car payment. They are underwriting the asset, not the individual. They are making a business loan to a business, and the business is the property itself. Your personal income is almost irrelevant. Let me repeat that, because it's the most important concept to grasp. With a DSCR loan, the lender barely looks at your personal income. They don't ask for tax returns. They don't ask for pay stubs. They are lending against the property's ability to generate cash flow. So how do they measure that? That's where the debt service coverage ratio comes in. It's a simple formula. It's the property's net operating income, or NOI, divided by its total debt service. Let's break that down with the duplex Jessica wanted to buy. First, net operating income. This is the total rent you collect, minus all the expenses associated with running the property, but not including the mortgage payment itself. So, things like property taxes, insurance, a budget for repairs, property management fees, and vacancy. Let's say the duplex brings in $4,000 a month in total rent. And let's estimate that the total operating expenses, taxes, insurance, maintenance, all that, come out to $1,000 a month. So, you take the $4,000 in rent, subtract the $1,000 in expenses, and you're left with $3,000. That is your net operating income. That's the cash the property generates before you pay the bank. The second part of the formula is the total debt service. This is just a fancy way of saying the full monthly mortgage payment, the principal, the interest, the taxes, and the insurance, often called PITI. Let's say for this duplex, the total mortgage payment is going to be $2,400 a month. Now we have our two numbers. The net operating income is $3,000. The debt service is $2,400. The formula is NOI divided by debt service. So, we take $3,000 and divide it by $2,400. The result is 1.25. That number, 1.25, is the debt service coverage ratio. It's the magic number. So what does it mean? A ratio of exactly 1.0 would mean the property's income perfectly covers its mortgage payment. Breaks even. Anything less than 1.0 means the property is losing money every month. It has negative cash flow. No lender will touch that. But 1.25? That tells the lender that the property generates 25% more income than is needed to cover the debt. It has a 25% cash flow buffer. It's a healthy, profitable investment. To a DSCR lender, that 1.25 is a beautiful shining green light. They see that number and they know their loan is safe. It's secured by an asset that pays for itself with money to spare. Most DSCR lenders are looking for a ratio of at least 1.2 or 1.25 to be safe. Some might go a little lower, some might want it higher, but that's the general target. And just like that, Jessica, who was rejected by the traditional bank, could now get her loan. The lender didn't need her tax returns. They didn't care that her personal debt-to-income was high. They cared about one thing, the quality of the deal she found. The loan wasn't approved because of how good a graphic designer she was. It was approved because of how good a real estate investor she was. This is a fundamental shift in thinking. Changes the game for so many people. It's perfect for the self-employed, the gig workers, the entrepreneurs whose income looks messy and inconsistent on paper, but who are actually incredibly successful. It's perfect for the W-2 employee who is trying to scale, who wants to buy their third, fourth, or 10th property, but has been cut off by conventional lenders who have a limit on how many mortgages one person can have. A DSCR lender doesn't care. If you bring them 100 properties and all 100 of them have a DSCR of 1.25 or higher, they will, in theory, fund all 100 deals. It also allows you to purchase properties inside of an LLC, a limited liability company, from day one. This is a huge deal for asset protection, separating your personal life from your business investments, something that can be very difficult or impossible with a standard conventional loan. Now, this probably sounds too good to be true, and in a way, you're right to be skeptical. There are, of course, trade-offs. The DSCR loan is not a magic wand. First, the interest rates are typically higher. You might pay 0.5%, a full percent, or even more than you would on a conventional loan. This is the price you pay for the flexibility and the streamlined process. Lenders take on a different kind of risk, so they charge a premium. Second, the down payment requirements are strict. You're not getting a DSCR loan with 5 or 10% down. You need to be prepared to put down at least 20%, and more commonly 25% or even 30%, especially as a first-time investor. You have to have significant skin in the game. And finally, the most important point, the deal has to be good. This type of loan forces you to be a disciplined investor. You can't overpay for a property that doesn't cash flow and hope it appreciates. The math has to make sense from day one. The property must generate enough income to meet that critical DSCR ratio. So the DSCR loan isn't a free lunch. It's a professional tool for serious investors. It's the vehicle that allows you to scale your portfolio based on the merit of your deals, not the limitations of your personal balance sheet. It's how you break free from the traditional 9-to-5 underwriting box and enter a world where the asset itself is what matters most. But this raises a critical question. The DSCR loan is perfect for a rent-ready property, A nice duplex like the one Jessica found. But what happens when the property isn't nice? What if you find a diamond in the rough? A property that's been trashed that needs a new roof, a new kitchen, and a complete overhaul before anyone can even think about renting it. A property with zero income today, but massive potential tomorrow. A DSCR loan won't work for that. The ratio would be 0. For that kind of project, you need a different kind of financing entirely. You need a short-term brute force financial tool designed not for cash flow, but for transformation. You need what the pros call hard money. Hard money isn't a loan in the traditional sense. It's a financial sledgehammer. It's a tactical tool used by real estate investors to do one thing: move with blinding speed. Forget everything you know about applying for a mortgage at your local bank. Forget the 2-inch thick stack of paperwork, the tax returns, the pay stubs, the endless waiting. A hard money lender is not a bank. They are private individuals or companies with deep pockets who have fundamentally flipped the lending equation on its head. A bank asks, "Who are you and can you afford to pay us back?" They scrutinize your credit score, your debt-to-income ratio, your job history. They are lending to you, the person. A hard money lender asks a completely different question. They ask, "What is the deal and is it good enough to pay us back?" They are lending on the asset. They are betting on the property's potential, not your personal financial history. This is the single most important distinction you need to understand. Your W-2 is irrelevant. Your credit score is a secondary consideration. The only thing that truly matters is the deal itself. Imagine this scenario. A wholesaler you work with calls you up. "I've got a deal, but you have to move fast. It's a 3-bed, 2-bath house in a great neighborhood, but it's a wreck. The owner needs to sell in 10 days, cash only. The price is $200,000. You run the numbers. You know that with about $50,000 in renovations, that house will be worth $400,000. It's a home run. You have $150,000 of profit sitting there waiting for you. So you call your bank. The loan officer practically laughs you off the phone. 10 days? Our appraisals alone take 3 weeks. We need 45 to 60 days to close minimum. By that time, the deal is long gone, snapped up by a cash buyer. This is the moment where 99% of aspiring investors hit a wall. But the professional investor makes a different call. They call their hard money lender. The conversation is completely different. The lender doesn't ask for your tax returns. They say, "Send me the address, the purchase price, your renovation budget, and the comps." Comps or comparables are the key. They want to see recent sales of similar fully renovated homes in that same neighborhood. They want to verify your claim that the house will be worth $400,000 when you're done. This future value is the holy grail of hard money lending. It's called the after repair value, or ARV. The ARV is everything. It is the North Star that guides every decision the hard money lender makes, because their entire risk is based on that number. If you, the borrower, default on the loan, they don't want your excuses. They want the house. They need to be confident that they can take the property, finish the renovation themselves, sell it, and get all their money back, plus a profit. Their loan is secured by the hard asset, the bricks and mortar, and its future unlocked potential. So, how do they structure these loans? It's not based on the traditional loan-to-value, or LTV, of the property as it is today. It's based on 2 other metrics: loan-to-cost and loan-to-ARV. Let's go back to our deal. The total cost of the project is the purchase price, $200,000, plus the renovation budget, $50,000, for a total of $250,000. This is your cost. A typical hard money lender might offer to finance, say, 90% of the purchase price and 100% of the renovation costs. So, they would give you 90% of $200,000, which is $180,000 for the purchase. And they would fund the entire $50,000 renovation budget. That's a total loan amount of $230,000. This means you, the investor, only need to bring the remaining 10% of the purchase price, $20,000, plus any closing costs, to the table. You're controlling a $400,000 asset with just a fraction of the total cost out of your own pocket. This is leverage in its most raw and powerful form. But there's a crucial safety check. The lender will have a maximum loan-to-ARV they're willing to accept, usually around 70% to 75%. In our case, the ARV is $400,000. 75% of that is $300,000. Our total loan is only $230,000, which is well below that $300,000 ceiling. For the lender, this is a fantastic deal. It's low risk.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Even if everything goes wrong and they have to foreclose, there is a massive equity cushion protecting their investment. This is why they can close in 7 to 10 days. The underwriting isn't about you. It's simple math based on the value of the deal. Now, this speed and leverage come at a steep price. Hard money is not cheap. You're not getting a 6% or 7% interest rate like a conventional mortgage. You should expect to pay anywhere from 10% to 15% in annual interest. On top of that, you'll pay origination fees known as points. 1 point is equal to 1% of the loan amount. Most hard money loans come with 2 to 4 points, paid upfront at closing. So on our $230,000 loan, 2 points would be an immediate fee of $4,600. And these loans are not long-term. They are short, aggressive instruments. You're typically looking at a term of 6 to 24 months, and the payments are almost always interest-only. The lender isn't expecting you to slowly pay down the principal over 30 years. They are expecting you to get in, execute your plan, and get out fast. The entire structure is designed to be temporary. It's a bridge. It gets you from the distressed, undervalued purchase to the stabilized, high-value finished product. You don't treat hard money like a mortgage. You treat it like a very expensive, very effective contractor. Its cost is simply another line item in your budget, right next to drywall and kitchen cabinets. You pay for the speed because the speed allows you to capture an opportunity that would otherwise be impossible to get. But this power comes with immense risk. The clock is ticking from the second you close. Every month that goes by, you're bleeding cash on those high-interest payments. If your renovation goes over budget, that money comes out of your pocket. If it takes longer than expected, those extra payments eat directly into your profits. If the market suddenly turns and your projected ARV drops, you could find yourself in a situation where you owe more than the house is worth. Hard money is a professional's tool. It assumes you know what you're doing. It assumes your renovation budget is accurate, your timeline is realistic, and your after-repair value is conservative. There is no safety net. If you fail to execute, you can lose your down payment, the money you put into the rehab, and the property itself. The lender will not hesitate to foreclose to protect their capital. So, if these loans are so expensive and so temporary, how do you actually make money? How do you get out of this high-cost debt? The answer lies in what's called the exit strategy. No hard money lender will even talk to you unless you have a clear, credible plan for paying them back within the loan term. You don't just walk into a hard money loan. You plan your escape from it before you even sign the papers. There are 2 primary escape routes, 2 main exit strategies that every successful investor masters. The first is to sell the property. This is the classic fix and flip. You use the hard money to buy and renovate the house, and then you sell it on the open market for its full retail value, that $400,000 ARV we talked about. From that sale price, you pay back the $230,000 hard money loan, you pay your realtor commissions and closing costs, and whatever is left over, hopefully over $100,000, is your profit. But what if you don't want to sell? What if you recognize this beautifully renovated house in a great neighborhood is a fantastic long-term rental property? You want to keep it, let a tenant pay down the mortgage, and enjoy the cash flow and appreciation for years to come. You can't do that with a 12-month 13% interest loan. You need to transition from that short-term brute force financing into a long-term, stable, and affordable mortgage. This is the second, and for many the most powerful exit strategy. This is where you refinance. And this is where the DSCR loan we discussed earlier makes its triumphant return to the story. So let's talk about this triumphant return. You've successfully navigated the treacherous waters of a short-term, high-interest hard money or bridge loan. You found a distressed property, you executed a brilliant renovation, and now you have a beautiful rent-ready asset. A tenant has moved in, they're paying rent on time, and the property is finally generating income. It has stabilized. It has graduated. This is the moment you've been working towards. The short-term loan did its job. It gave you speed and flexibility when you needed it most. But its time is up. Paying 10, 12, or even 15% interest is like a ticking clock, and you need to defuse it. This is where you refinance. You're essentially trading in that expensive temporary loan for a long-term, fixed-rate mortgage, the kind that lasts for 20 or 30 years. And the perfect tool for this job is often the debt service coverage ratio, or DSCR loan. Now, why is the DSCR loan so perfect for this specific moment? Remember the key feature we discussed? The lender is not primarily concerned with your personal W-2 income, your tax returns, or your day job. They have one laser-focused question. Does the property itself generate enough income to cover its own mortgage payment and expenses? That's it. That's the entire game. When you first bought the property, it was a wreck. It wasn't generating any income, so a DSCR loan was impossible. But now it's a cash-flowing machine. And the lender can look at the signed lease agreement, they can see the rent checks coming in, and they can underwrite the loan based on the property's performance, not yours. This is a monumental shift. It separates your personal finances from your investment business, allowing you to scale in a way that's simply not possible with conventional loans that are tied to your personal debt-to-income ratio. So let's walk through the mechanics. How does this actually work? The process is called a cash-out refinance. The name itself tells you the best part of the story. Let's use our running example. You bought the property for $200,000 using a hard money loan. You put another $50,000 into the renovation. Your total investment, your all-in cost, is $250,000. During the renovation, you forced appreciation. You took a rundown house and turned it into the nicest one on the block. Now, you get a new appraisal as part of the refinance process. And because of your hard work and smart upgrades, the appraiser determines the property is now worth $350,000. This is your after-repair value, or ARV, and it is the most important number in this entire equation. You take this new appraisal to a DSCR lender. They'll look at the property's financials. Let's say it rents for $3,000 a month. They'll calculate the property's expenses, things like property taxes, insurance, a vacancy factor, and maintenance reserves. Let's say all that comes out to about $800 a month. That leaves you with a net operating income, or NOI, of $2,200 per month. The lender says, okay, we're comfortable with a loan-to-value, or LTV, of 75% on this cash-out refinance. This is a very standard number. So they'll give you a loan for 75% of the new appraised value. 75% of $350,000 is $262,500. This is the size of your new long-term mortgage. Now for the magic. Your new loan is for $262,500. What do you do with that money? First, you pay off the original hard money loan of $200,000. Poof, it's gone. Next, you pay yourself back for the entire $50,000 renovation cost. That capital is now back in your bank account. So you've paid off the acquisition loan and you've paid back your renovation costs. That's a total of $250,000. But wait, your new loan was for $262,500. You've only used $250,000 of it. What happens to the remaining $12,500? That comes to you. At the closing table, the title company hands you a check for $12,500. Let's just pause and absorb what just happened. You now control a $350,000 income-producing asset. You have a stable long-term mortgage on it. You have pulled out every single penny of your original investment, the purchase price and the rehab money. And on top of that, you were paid $12,500 just for doing the deal. And because that money came from a loan, it's considered debt, not income, so it's tax-free. This is the core of the BRRR strategy: buy, rehab, rent, refinance, repeat. You have just completed the fourth and most critical step. You're left with a rental property that is paying for itself, generating monthly cash flow, and you have all of your original capital back, ready to deploy on the next project. You can now repeat. This is the concept of infinite returns. You have zero of your own money left in the deal, yet you own an appreciating asset that produces monthly income. This is how you build a real estate portfolio with a finite amount of capital. Instead of saving up for years to get another 20% down payment for your next property, you use the same pot of money over and over and over again. This is the velocity of money. It's what separates amateur investors from professional operators who build massive portfolios in a matter of years, not decades. Now, this all sounds a little too good to be true. So let's address the realities and the potential hurdles. Lenders aren't just handing out this money without some rules. The most common one is called a seasoning period. A lender wants to see that you can actually manage the property and that the tenant you placed is reliable. They want to see a track record. A typical seasoning period is 6 months, but it can sometimes be up to a year. This means you need to have owned the property for that amount of time before they'll do a cash-out refinance based on the new higher value. During this period, you're still paying that expensive hard money loan, so you have to factor those holding costs into your initial budget. The second major hurdle is appraisal risk. This entire strategy hinges on the property appraising for your target after repair value. If you projected it would be worth $350,000 but the appraisal only comes in at $320,000, your entire calculation changes. A 75% loan on $320,000 is only $240,000. In that scenario, you wouldn't be able to pull all of your $250,000 investment out. You'd have to leave $10,000 of your own cash in the deal. It's still a great outcome. You'd own a cash-flowing property for just $10,000 out of pocket, but it's not the home run you planned for. This is why accurately calculating your ARV up front is the most critical skill for a real estate investor. Finally, you have to remember that DSCR loans are commercial-style products. The interest rates are typically a bit higher than what you'd get on a conventional mortgage for your primary residence. Lenders price for risk, and a loan on an investment property, underwritten without looking at your personal income, is inherently riskier for them. But smart investors don't get fixated on the interest rate. They fixate on the deal structure. Is the monthly rent more than enough to cover the mortgage, taxes, insurance, and other expenses? If the answer is yes, and the deal allows you to pull out your capital to go again, then a slightly higher interest rate is just the cost of doing business, a cost that your tenant is paying for you. This refinance strategy, this elegant dance between short-term and long-term debt, is the engine of wealth creation for so many real estate investors. It's how you turn one pile of cash into a portfolio of properties. But what if holding property long-term isn't your goal? What if you don't want to be a landlord? What if you just want to get in, get out, and get paid? Well, that brings us to our third and final exit strategy, the one you see on all the TV shows. This is where you flip it. The flip. It's the grand finale of every home renovation show. The dramatic before and after, the sledgehammers, the open house with fresh-baked cookies, and that final glorious number revealing the profit. And let's be honest, it looks incredibly appealing. You buy the worst house on the best block, you work some magic, and you walk away with a check for $50, $60, maybe even $100,000 in just a few months. No tenants, no toilets, no long-term commitment. Just pure, unadulterated profit. But how does it actually work? How do you fund a project where the goal is to sell it, not hold it? You can't exactly walk into a bank and say, "Hi, I'd like a 30-year mortgage for a house I plan to gut and sell in 6 months." They'd look at you like you have 3 heads. This is where a very specific and very powerful type of investment loan comes into play. The fix and flip loan, also known as a hard money loan or a bridge loan. Think of this loan as a short-term, high-octane financing tool built for speed and value creation. Unlike a conventional loan that's based on the current condition of the property, a fix and flip loan is based on its future potential. Lenders in this space don't just see the peeling paint and the 1970s shag carpet. They see the finished product. They lend based on a magic number called the ARV, or after repair value. The ARV is the estimated value of the property after all your proposed renovations are complete. A professional appraiser will look at your plans, your renovation budget, and then look at what similar fully renovated homes, we call these comps, have recently sold for in that exact neighborhood. That final, renovated market price is your ARV, and it is the North Star for your entire project. So let's build a deal from the ground up. You find a property. It's a mess, but it has good bones and it's in a great school district. The seller is motivated and wants to unload it fast. The asking price is $220,000, but you negotiate it down to $200,000. You bring in your contractor, and together you create a detailed renovation budget. A new kitchen, 2 new bathrooms, new flooring, fresh paint, and some curb appeal. The total, all-in cost for the renovation is going to be $50,000. So your total project cost is the purchase price plus the renovation cost. $200,000 plus $50,000 equals $250,000. Now you go to a fix and flip lender. You show them the deal, your experience, and your contractor's budget. They send out their appraiser who agrees with your assessment. He determines that once your $50,000 of work is done, the house will be worth $350,000 on the open market. That's your ARV. Here's where the magic happens. The lender isn't just going to lend you money for the purchase. They're often willing to finance a portion of the renovation costs too. This is a game changer. A typical offer might be a loan for 85% of the total project cost. So, they'll lend you 85% of that $250,000 figure. That comes out to a loan of $212,500. This means your total cash needed to get into the deal isn't 25% of the $200,000 purchase price. It's the total project cost of $250,000, minus the loan amount of $212,500. You need to bring $37,500 to the table. This is how investors can do multiple projects at once. They aren't tying up hundreds of thousands of dollars in a single property. They're leveraging the lender's capital to fund the majority of the deal, including the repairs. Now, the lender isn't just going to hand you a check for $212,500 and wish you good luck. It doesn't work that way. At the closing, they will fund the $200,000 to buy the house. The $50,000 for renovations is held by them in an escrow account. You start the work using your own capital to get the first phase done, let's say the demolition and framing. Once that's complete, you call the lender and request a draw. They send an inspector to the property to verify the work is done. Once it's approved, they release the first portion of the renovation funds to you, reimbursing you for the work completed. You use that money to fund the next phase, plumbing and electrical, and the process repeats. This draw process protects both you and the lender, ensuring the project stays on track, and the money is used as intended. Of course, this is where the reality of flipping diverges from the fantasy of television. On TV, they always find some unexpected disaster behind a wall that adds drama. In real life, that disaster adds thousands of dollars to your budget and weeks to your timeline. Your $50,000 renovation budget can quickly balloon to $65,000. Your contractor could disappear for a week. Your custom cabinets could arrive damaged. Every single day of delay costs you money. This is because fix and flip loans are short-term, typically 6 to 12 months, and they usually have higher interest rates than a 30-year mortgage. And you're paying what are called holding costs the entire time. Holding costs are the silent profit killers. They are the loan interest payments, the property taxes, the insurance, the electricity bill, the water bill. Every month that ticks by, these costs are eating away at your potential profit margin. The name of the game in flipping is speed. Get in, get the work done, and get out. But let's assume your project goes smoothly. The renovation takes 4 months. You put it on the market, beautifully staged, and in the 5th month, you accept a full price offer for your ARV of $350,000. We're all celebrating, right? We made $100,000. Well, not so fast. Let's do the real math. Your sale price is $350,000. First, you have to pay off the loan. That's $212,500 gone right off the top. Then, you have to remember the costs of selling. Real estate agent commissions are typically 5 to 6% of the sale price. Let's call it 5%, so that's $17,500. Then you have seller-paid closing costs, title fees, and taxes. Let's budget another 2%, or $7,000. So selling costs total around $24,500. And don't forget your holding costs for the 6 months you own the property from purchase to sale. Let's say your interest-only loan payments, taxes, and insurance averaged about $2,500 a month. That's another $15,000. So let's tally it up. You started with $350,000 from the sale. You subtract the $250,000 it cost to buy and rehab the house. That leaves you with $100,000 in gross profit. Now, subtract the $24,500 in selling costs. You're down to $75,500. Finally, subtract the $15,000 in holding costs. Your final net profit, the actual cash that goes into your bank account, is $60,500. Now, is a $60,500 profit for 6 months of work and risk a fantastic return on your initial investment of $37,500? Absolutely. It's over a 160% cash-on-cash return. That's a home run. And that is the power and the allure of the flip. It's a high-risk, high-reward strategy that allows you to force appreciation and generate large chunks of capital in a short period of time. So now you understand the 3 core exit strategies. You can hold the property and rent it out for long-term cash flow like we discussed with the DSCR loan. You can use the BRRR method to refinance, pull your cash back out, and repeat the process. Or you can fix and flip for a quick, substantial profit. Each strategy is a different tool for a different job, and each is powered by a specific type of investment loan. The question is no longer, what can I do? The question now becomes, what will a lender let me do? How do they look at you, the investor? What do they care about? Is it your credit score? Your income? Your experience? How do you get from knowing these loans exist to actually getting approved for one? That's where we're going next. We're pulling back the curtain on the underwriting process. Alright, let's peek inside the lender's brain. When an underwriter gets your loan application, they aren't just looking at a stack of papers. They're trying to answer one fundamental question. If I give this person this money, what is the probability I will get it back with interest? That's it. Everything else is just a detail that helps them answer that one question. And for investment property loans, they answer it by looking at 3 core pillars. Think of it like a 3-legged stool. If one leg is a little wobbly, the other 2 have to be rock solid to keep it from tipping over. The first, and arguably most important pillar, is the property itself. This is the biggest difference between getting a loan for your personal home versus an investment property. With your primary residence, the loan is all about you. Your income, your job history, your debt. But with an investment loan, the star of the show is the asset, the property. The lender sees that building not as a home, but as a small business. And their first question is this a good business to invest in? They figure this out primarily through an appraisal. But it's not just any appraisal. It's an investment-focused appraisal. They're looking at the property's condition, of course. A crumbling foundation is a red flag for any loan. But they're also laser-focused on its location, the local rental market, and its potential to generate income. A 2-bedroom condo in a booming tech hub is a very different business than a 4-plex in a town with a shrinking population. The appraiser will pull rental comps, comparable rental properties in the area, to establish what's called the market rent. This isn't what you think you can get for rent. It's what the data says the property is likely to command. This number is non-negotiable and forms the foundation for all the math that follows. The lender is essentially underwriting the property's ability to pay for itself, independent of you. The second pillar is you, the borrower. Now, just because the property is the star doesn't mean you're not in the movie. You are the director, and the lender needs to know you're competent. They assess this in a few ways. First, your credit score. In the world of investment loans, your FICO score is less about getting approved and more about determining your interest rate. Think of it as your reputation score. A high score, say 720 or above, tells the lender you have a long history of paying your debts on time. You're reliable. A lower score, maybe in the 600s, tells them you've had some hiccups. They might still lend to you, but they're going to charge you a higher interest rate to compensate for that added risk. It's their insurance policy against your reputation. Next, they look at liquidity. This is a big one. Liquidity is just a fancy word for cash, or assets you can convert to cash very quickly. Lenders want to see that you have reserves. They call this post-closing liquidity. After you've paid the down payment and all the closing costs, how much cash do you have left in the bank? They want to see that you can cover the mortgage payments, taxes, and insurance for a certain number of months, typically 3 to 6, even if the property sits vacant. Why? Because vacancies happen. A tenant moves out, and it takes you 2 months to find a new one. An air conditioner dies and you need $5,000 tomorrow. Your reserves tell the lender that you can handle the inevitable bumps in the road without immediately defaulting on their loan. Proves you're not running on fumes. Finally, under this pillar is experience. For first-time investors, this can be the trickiest part. Some lenders, especially on larger multifamily deals, want to see a track record. Have you owned and managed rental properties before? If not, you might have to start with a simpler property like a single-family home or a duplex to build that resume. But don't let this discourage you. Many lenders are open to first-timers, especially if the other 2 pillars, the property and the deal itself, are strong. And that brings us to the third pillar, the deal. This is where the math happens. It's the raw numbers that connect you and the property. The 2 magic acronyms you need to know here are LTV and DSCR. Let's start with LTV, which stands for loan to value. It's simpler than it sounds. It's just the loan amount divided by the property's appraised value. If a property is appraised at $200,000 and you're getting a loan for $160,000, your LTV is 80%. The remaining $40,000 is your down payment. From the lender's perspective, LTV represents their risk exposure. An 80% LTV means they're on the hook for 80% of the property's value, and you're covering the other 20%. That 20% is your skin in the game. It gives the lender a cushion. If you default and they have to foreclose, the property's value could drop 20% before they start losing their own money. This is why a lower LTV, meaning a larger down payment from you, is always more attractive to a lender. It reduces their risk. For investment properties, you'll typically see LTVs capped around 75% or 80%, much lower than the 97% you might see on a primary home loan. Now for the most important metric of all, the one that truly separates investment lending from everything else: DSCR. Debt Service Coverage Ratio. This sounds complicated, but the concept is beautiful in its simplicity. It answers the most critical question: does the property's income cover its expenses? The formula is just the property's net operating income divided by its total debt service. To put it even more simply, it's what the property earns divided by what it owes. The net operating income is the gross rent minus all the operating expenses, things like taxes, insurance, maintenance, and property management fees. The debt service is the total of your principal and interest mortgage payments for the year. If a property brings in $20,000 a year in net income, and the mortgage payments for the year are $16,000, your DSCR is $20,000 divided by $16,000, which equals 1.25. What does that 1.25 mean? It means that for every $1 of debt you have to pay, the property generates $1.25 in income. That 25-cent cushion is your cash flow. It's the lender's margin of safety. Most lenders will require a DSCR of at least 1.2, and some prefer 1.25 or higher. If the DSCR is 1.0, it means the property is breaking even. Every dollar of income is going out to pay the debt, leaving nothing for you or for unexpected repairs. If the DSCR is less than 1.0, the property is losing money every single month, and you have to feed it cash from your own pocket just to stay afloat. A lender will almost never approve a loan on a property with a DSCR below 1.0. It's a deal killer. So those are the three pillars: a solid property, a reliable borrower, and a profitable deal defined by LTV and DSCR. Remember the three-legged stool. A fantastic, cash-flowing property in a great location might allow a lender to overlook a borrower's lack of experience. A borrower with a stellar credit score and tons of cash reserves might be able to get a deal done on a property with a slightly tighter, but still acceptable DSCR. It's a balancing act. The underwriter is weighing all these factors to answer that one question: will I get my money back? Understanding this framework is your key to the kingdom. You no longer have to guess what lenders want. You now know their playbook. You can analyze a potential deal through their eyes and see its strengths and weaknesses before you even apply. This knowledge transforms you from a hopeful applicant into a professional investor who brings lenders deals they want to fund. Now that you know how they think, let's talk about the specific tools they offer. Because the loan for a quick flip is vastly different from the one you'd use for a long-term rental portfolio. Choosing the right product is the next critical step. So let's break down the investor's toolkit. Think of these loans not as debt, but as specialized instruments, each designed for a specific job. Broadly, they fall into two categories: loans for speed and loans for stability. Let's start with speed. This is the world of flippers, rehabbers, and opportunists. Investors who make their money by getting in, transforming a property, and getting out fast. Their number one enemy is time. Every day they hold a property, it costs them money, so they need funding that is incredibly fast and flexible. This brings us to the first and most famous tool: the hard money loan. The name itself sounds intense, and it is. A hard money loan is the rocket fuel of real estate investing. It's expensive, it burns fast, and it will get you where you need to go with breathtaking speed. Forget everything you know about a traditional mortgage. A hard money lender doesn't care about your W-2 from last year. They don't really care about your personal debt-to-income ratio. They care about one thing and one thing only: the deal. The property is the star of the show. Here's how it works. You find a distressed property. Let's say it's a house with a leaky roof, dated kitchen, and overgrown yard for $200,000. A conventional bank would run for the hills. They see risk. A hard money lender sees opportunity. You bring them the deal and say, I can buy this for $200K, I need $60K to renovate it, and in 6 months it will be worth $400K. The hard money lender will do their own analysis, and if they agree with your numbers, if they believe in the after repair value or ARV, they'll often fund not just the purchase but the repairs too. This is a massive advantage. They might lend you 80 or 90% of the purchase price and 100% of the rehab costs. You could get into a $250,000 project with very little of your own cash out of pocket. Now for the catch. And it's a big one: the cost. Hard money is not cheap. You're not going to get a 6% interest rate. You're looking at rates that can be anywhere from 10% to 15% or even higher. On top of that, you'll pay points up front, which are percentage fees of the loan amount. So a loan might have a 12% interest rate plus 2 points.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
This is why you only use it for short-term projects. These are not 30-year loans, they're typically 6, 12, or maybe 24-month loans. The entire business model is built on the assumption that you will be in and out quickly. You buy it, you fix it, you sell it, and you pay back the loan, pocketing the difference. You might be thinking, why on earth would anyone take that deal? Because speed is money. A conventional loan can take 45 to 60 days to close. A hard money loan can close in 7 to 10 days. In a competitive market, that speed allows you to beat out other offers. It allows you to scoop up deals that other slower-moving investors can't touch. The high interest rate isn't a burden you carry for years. It's a calculated business expense, like the cost of lumber or hiring a contractor. You factor it into your profit margin from day one. The danger, of course, is if your project gets delayed. If your 6-month flip turns into a 12-month saga because of permit issues or a bad contractor, that 12% interest starts to feel like a concrete boot, dragging your profits down to the bottom of the ocean. Closely related to hard money is another speed tool: the bridge loan. As the name implies, it's designed to bridge a gap. Imagine you're in the middle of a successful flip. It's on the market, you have a buyer, but it won't close for another 45 days. Suddenly, the perfect property for your next project pops up. An incredible deal, but the seller wants to close in 2 weeks. All your capital is tied up in the first project. What do? You get a bridge loan. It's a very short-term loan, sometimes just for a few weeks or months, that gives you the funds to acquire the new property. The moment your first property sells, you use the proceeds to pay off the bridge loan, and then you're off to the races on the new project. It's a specialized tool for maintaining momentum, ensuring you never miss an opportunity just because of a temporary cash flow crunch. So that's the world of speed. But what if your goal isn't a quick profit? What if you're playing the long game? The game of wealth building, passive income, and creating a legacy. This is the world of the buy and hold investor, and they need loans built for stability and scale. This brings us to the single most powerful tool for the modern rental property investor: the DSCR loan. DSCR stands for Debt Service Coverage Ratio, and if you plan to own more than a couple of rental properties, these 3 letters will change your life. A DSCR loan completely flips the script on how a loan is underwritten. Remember how a conventional lender scrutinizes your personal income, your job history, your credit card bills? A DSCR lender ignores almost all of that. They ask one simple question: does the property itself generate enough income to cover its own expenses? Let's break down the ratio. Debt service is just a fancy term for the total mortgage payment: principal, interest, taxes, and insurance or PITI. The lender looks at the gross rent the property can generate and divides it by the PITI. For example, if the property rents for $2,500 a month, and the total mortgage payment is $2,000, your DSCR is $2,500 divided by 2,000, which equals 1.25. Most DSCR lenders want to see a ratio of 1.2 or higher. That 1.25 tells them that the property generates 25% more income than is needed to cover the mortgage payment. It has a built-in cash flow buffer. If the property can prove that, the lender doesn't need to see your pay stubs. They don't care if you're a salaried employee, a freelancer, or retired. The property qualifies for the loan on its own merit. This is the key to unlocking unlimited scale. With conventional loans, you eventually hit a wall. Lenders will cap you at a certain number of mortgages, maybe 10, and your personal debt-to-income ratio becomes a major hurdle. With DSCR loans, there is often no limit. As long as you can keep finding properties that cash flow and meet the ratio, you can keep acquiring them. This is how investors go from 1 rental to 5, from 5 to 20, from 20 to 100. The business scales itself because each asset pays for itself. The trade-offs? DSCR loans typically require a larger down payment, usually 20 to 25%, because the lender has less recourse to your personal income. The interest rates are also a bit higher than a conventional owner-occupied mortgage. But just like with hard money, this higher rate is simply a cost of doing business, factored into the cash flow calculation. It's the price you pay for speed, flexibility, and scalability. Finally, for the investor who has already started to scale, there's the portfolio loan. Imagine you've used DSCR loans to buy 7 different rental properties over the past few years. You now have 7 separate loans, 7 different monthly payments to track, and 7 different interest rates. It's a logistical headache. A portfolio loan allows you to consolidate all of them. You essentially refinance all 7 properties at once, bundling them into one single larger loan with one single monthly payment. This doesn't just simplify your bookkeeping. It's a powerful strategic tool. By combining the equity from all 7 properties, you can often do a cash-out portfolio loan. This means the new loan is larger than the combined total of the old loans, and you get the difference in cash, tax-free. You can then use that massive chunk of capital as a down payment to go out and buy another 5 or 10 properties, dramatically accelerating your growth. It's like hitting a turbo boost button on your portfolio's expansion. The risk, however, is that the properties are now cross-collateralized. This means if you have a problem with one property and can't make the payment, the lender can come after the entire portfolio. It's a high-stakes move that requires diligent management. So you have the fast-burn rocket fuel of hard money for flips, and the steady, powerful engine of DSCR loans for rentals. You have bridge loans to cross short-term gaps and portfolio loans to consolidate and scale up. Each is a specific tool designed for a specific strategy, but knowing which tool to use is only half the battle. Now you have to find the right person, the right company to actually give you the tool. And finding the right lender is an art form in itself. It's the single biggest mistake I see new investors make. They spend months, sometimes years, analyzing markets, running numbers, finding the perfect deal. And then they spend about 5 minutes finding a lender. They just walk into the same bank where they have their checking account and assume that's the best they can do. That's like training for the Olympics and then showing up on race day wearing a pair of flip-flops. The lender you choose is not just a bank. They are a critical member of your team. A great lender can save a borderline deal. A bad lender will kill a perfect one. Every single time. So, how do you navigate this landscape? Let's break down the major players you'll encounter on your quest for financing. Think of it like assembling a crew for a high-stakes mission. First, you have the giants. These are your big, national household name banks. The Bank of Americas, the Chases, the Wells Fargos of the world. The appeal here is obvious. Familiarity. You probably already have a relationship with one of them. Their sheer size means they can offer a vast array of products, and sometimes, if you have significant assets with them, they can offer relationship-based pricing. But here's the catch for an investor. These giants are battleships. They are immensely powerful, but they turn slowly. They are built on layers of bureaucracy and standardized, one-size-fits-all underwriting. Their primary business is the plain vanilla 30-year fixed mortgage for a primary residence. When you bring them an investment deal, maybe a duplex with a value-add component, or a property you're buying using a creative strategy, their internal systems often short-circuit. The loan officer you talk to at the local branch might be great at getting a mortgage for your neighbor's suburban home, but they've likely never even heard of a DSCR loan. For a straightforward, cookie-cutter rental property, they might be fine. For anything else, you risk getting stuck in underwriting purgatory for months, only to be denied at the last minute for a reason that makes no sense. Next up, we have the community champions. These are your local and regional banks and credit unions. These institutions are the opposite of the faceless giants. Their superpower is local market knowledge. The underwriter might live 3 towns over. They might drive past your potential investment property on their way to work. They understand the nuances of your city's neighborhoods in a way a desk jockey in another state never could. Because they're smaller, you often have better access to decision makers. You're not just a number in a queue. You're a local business person they want to build a relationship with. This can translate into more flexibility and common sense underwriting. The downside? Their product offerings might be more limited. They may not have the super specialized investor loans we've talked about, and their lending capacity might be smaller. They are fantastic for building a long-term local portfolio, but they might not have the right tools for a high-volume or highly specialized strategy. Then you have the specialists, also known as mortgage brokers. A good mortgage broker is like a master matchmaker for money. They don't lend their own funds. Instead, they maintain relationships with dozens, sometimes hundreds of different lenders, from the giants to small niche funds you've never heard of. Your job is to sell one person on your deal, the broker. Their job is to then take your loan package and shop it to the lender who is most likely to approve it on the best possible terms. This is a massive advantage. You fill out one application, and you get access to a huge marketplace of capital. Brokers are often investors themselves and speak your language. They know which lender is great for BRRR deals, which one loves small multifamily, and which one is offering a special on cash-out refinances this month. The caveat is that not all brokers are created equal. Their compensation comes from the lender, which can sometimes create a conflict of interest. A great broker is your advocate. A mediocre one is just a salesperson trying to fit a square peg into a round hole to get a commission. The key is finding a broker who specializes in investment properties. Finally, we have the speed demons, hard money and private lenders. These are your special forces. When you have a deal that needs to close in 10 days, or a property that's in such bad shape no traditional bank will touch it, this is who you call. Hard money lenders are professionals who provide short-term, asset-based loans. They care less about your personal income and credit score, and more about the quality of the deal itself. Is there a clear path to profitability? Is the property in a good location? They are looking at the after-repair value or ARV. The cost for this speed and flexibility is high. Expect interest rates in the double digits and several points, or percentage-based fees up front. These are not long-term loans. You use them to acquire and renovate a property, then you refinance out into a more stable long-term loan. Private lenders are similar, but are often individuals or small groups lending their own money. The terms can be even more flexible and creative because you're negotiating directly with the source of the capital. This is relationship-based lending at its purest. So, with all these options, how do you choose? You interview them. You put them through their paces. Never ever just accept the first offer you get. You are the customer. You are the one bringing them a profitable opportunity. You should approach finding a lender with the same seriousness as hiring a key employee. Here are the 5 killer questions you must ask every potential lender. Question 1. How many loans for investment properties have you personally closed in the last 12 months? Notice the specificity, not just how many loans. You want to know if they are in the investor space day in and day out. If they hesitate or give a low number, they are not a specialist. Move on. Question 2. What is your average time from a complete application to clear to close for a deal like mine? This question tests their experience and sets expectations. An experienced lender will give you a confident, realistic range. A novice will say, "Oh, it depends," or give you a wildly optimistic number they can't possibly hit. Question 3. Who will be my single point of contact throughout this process? This is critical. In large institutions, your file can be passed from the loan officer to a processor to an underwriter to a closing department. When there's a problem, everyone points fingers. You want one person who is ultimately responsible for your file. One throat to choke, so to speak. Question 4. Can you provide me with a detailed fee sheet, outlining every single cost, from appraisal to underwriting to processing and title fees? You want to see everything. Some lenders will quote you a great rate, but then bury you in junk fees on the back end. Transparency is non-negotiable. And the final, most important question. What do you see as the biggest potential challenge in getting this specific loan approved? This is the master key. This question forces them to put on their underwriter hat and actually analyze your deal. A great lender will give you an honest, thoughtful answer. They might say, "Your debt to income is a little tight, so we need to make sure we document all your rental income properly." Or, "The appraisal on this type of unique property could be tricky, so we need to use an appraiser with experience in the area." Their answer will tell you everything you need to know about their competence. A bad lender will just say, "Oh, it'll be no problem at all." That's a massive red flag. Choosing your lending partner is a strategic decision that will echo through your entire investing career. It's about more than just an interest rate. It's about finding a partner who understands your vision, who can execute with speed and precision, and who will be there to help you solve problems when they inevitably arise. Because once you have that perfect lender and that perfect loan, you're finally at the starting line. Now, you just have to get to the finish. You have to navigate the final treacherous steps of the closing process, a place where even the best laid plans can fall apart. This final gauntlet is called underwriting and closing. It's where your loan application goes from a hopeful, maybe, to a legally binding yes. It's where the lender stops taking your word for it and starts demanding proof for everything. Think of it as a financial audit, a property investigation, and a legal marathon all rolled into one. Your loan officer has been your guide, but now your file is handed over to the underwriter, the ultimate gatekeeper. Their job isn't to be your friend. Their job is to protect the lender's money by stress testing every single piece of your application. They will re-verify your income, calling your employer and scrutinizing your pay stubs and tax returns one last time. They'll re-pull your credit to make sure you haven't gone out and bought a new car or opened a dozen credit cards. They will source every large deposit in your bank accounts, demanding to know where that $10,000 came from. A gift from a relative? They'll need a signed gift letter and proof of the funds from the giver's account. Sold some stock? They'll want the trade confirmations. Every dollar you're using for the down payment and closing costs must be accounted for, tracked, and verified. This is not the time for financial mysteries. It's a process of total transparency, and it can feel incredibly invasive. But from their perspective, they are about to hand you hundreds of thousands or even millions of dollars. They have a right to be certain you are who you say you are, and that you can handle the debt you're about to take on. Simultaneously, while you're being put under the microscope, the property itself is facing its own judgment day. This comes in the form of the appraisal. The lender hires an independent, third-party appraiser to determine the fair market value of the property. This is one of the most nerve-wracking moments in the entire process. The appraiser will visit the property, measure it, take photos, note its condition, and then compare it to similar properties that have recently sold in the area. The comps. The number they come back with is monumental. The entire loan is based on this value. If the appraisal comes in at or above your purchase price, everyone breathes a sigh of relief. The deal is on track. But what if it comes in low? This is a deal killer. Let's say you agreed to buy a duplex for $500,000, and you're putting 25% down. The lender has agreed to loan you $375,000, but the appraiser says the property is only worth $470,000. The lender will now only loan you 75% of that new lower value, which is just over $352,000. Suddenly, you have a nearly $23,000 gap. You have three options, none of them great. You can try to renegotiate the price with the seller, you can come up with that extra $23,000 in cash, or you can walk away from the deal. This is where a solid real estate agent becomes invaluable, helping you navigate these high-stakes negotiations. While the appraisal drama is unfolding, another critical process is happening in the background: the title search. A title company is hired to act as a detective, digging through historical records, deeds, and public documents to ensure the seller has the legal right to sell you the property. They're looking for skeletons in the closet, old mortgages that were never paid off, tax liens from the IRS, ownership claims from a long-lost heir, or boundary disputes with a neighbor. Anything that could threaten your ownership is called a cloud on title. The title company's job is to find and help clear these clouds before you close. Once they're confident the title is clean, they will issue a title insurance policy. This isn't like homeowners insurance that protects the house itself. This protects your right to own the house. It's a one-time fee paid at closing that protects you from unforeseen title claims for as long as you own the property. It is absolutely non-negotiable. All of these moving parts, your financial underwriting, the property appraisal, the title search, are typically coordinated by an escrow officer or a closing attorney. This neutral third party acts as the trusted intermediary. You give them your down payment money. The lender gives them the loan money. The seller gives them the deed to the property. They hold everything in a secure account, called escrow, and only release the funds and documents once every single condition of the contract has been met. They are the air traffic controllers of the transaction, ensuring everything lands safely and at the right time. After weeks of sending documents, answering questions, and waiting anxiously, you'll hopefully hear the four most beautiful words in real estate: you are clear to close. This means the underwriter has signed off. The appraisal is good. The title is clean. The lender is officially ready to fund your loan. But you're not done yet. By law, you must be given your final closing disclosure, or CD, at least 3 business days before you are scheduled to sign the final papers. This document is the final, itemized breakdown of your entire transaction. It lists your loan amount, interest rate, monthly payment, and every single closing cost down to the penny. It will show exactly how much money you need to bring to the closing table. Your job is to review this document with the intensity of a forensic accountant. Compare it to the loan estimate you received at the beginning. Are the fees what you expected? Is your name spelled correctly? Is the loan amount right? A tiny mistake here can cause massive delays or cost you thousands of dollars. If you find an error, you must raise the alarm immediately. Finally, the day arrives. Closing day. You'll go to the title company or attorney's office. You will be sat in front of a stack of paper so thick it could stop a bullet. You will sign your name over and over and over again. You'll sign the promissory note, your legally binding promise to repay the loan. You'll sign the mortgage or deed of trust, which gives the lender the right to foreclose if you don't pay. You'll sign endless disclosures and affidavits. Your hand will cramp. Your mind will go numb. But you will sign. And before you arrive, you will have already wired or brought a cashier's check for the final amount shown on your closing disclosure. Your down payment plus all closing costs. Once the last page is signed and your funds are received, the escrow officer gives the green light. They fund the loan, wiring the lender's money to the seller. They record the new deed with the county, officially making you the legal owner of the property. And then it happens. The moment this entire grueling journey has been about, the title agent slides a set of keys across the table. They're yours. You did it. You navigated the labyrinth of investment financing. You conquered the mountain of paperwork. You have successfully leveraged other people's money to purchase an asset, a piece of the American dream that can now start working for you. This whole process from the first video to this moment has been about one thing: demystifying a powerful tool. An investment loan isn't just a debt. It's a key. It's the key that can unlock the door to financial independence, to generational wealth, to a future you build instead of one that just happens to you. We've talked about the different types of loans, from conventional to hard money. We've explored how to find the right lender and how to present yourself as the ideal borrower. We've broken down the numbers, the ratios, and the jargon. We've walked through the application, the underwriting, and the closing. You now have the full picture, the complete roadmap. The path is not simple. It demands diligence, patience, and a willingness to be scrutinized. It requires you to be organized, responsive, and resilient. There will be moments of frustration and anxiety. Deals will fall through. Lenders will say no. But it is not an impossible path. It is a defined process, and now you understand that process. The knowledge is no longer a barrier. You now speak the language. You understand the rules of the game. The only question left is, what will you build with it? The power of leverage is now in your hands. Go use it.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.